Welcome to FinTalk with Em. Good to see you if you're new here, and welcome back if you're returning. Today I'm going to share with you some best online investment options for NRI beginners. Firstly, let's address the elephant in the room. Why invest in India? It's no news that due to its lower monetary value against foreign currencies of most developed nations, Indian rupees has the potential to gain greater financial value in India. To put that in layman's terms, as of filming this video, $1 will get you roughly around 81 rupees, or 1 British pound can get you roughly around 100 rupees. You would get a lot more value from the 100 rupees or 81 rupees in India than you would from $1 in the US or 1 British pound in the UK. That's some basic economics. Now that can't be the only reason you should invest in India. Here are some more. India is on a rapid economic growth trajectory. A recent report suggested that India is on track to become the world's third largest economy by 2027. And furthermore, with India's economy currently in a very stable state, it further reduces the risk on investment. Now, let's look at some online investment options if you are a beginner. I have 4 recommendations based on 3 risk categories. Pick the one that suits your risk profile. First is fixed deposits, which is of low risk category. Number 2 is mutual funds. This includes ETFs and index funds. This is medium risk category. Number 3 is stock trading, which is of high risk category. And number 4 is bond trading, which is low risk category. Let's first take a look at fixed deposits. Now, as you may be aware, India offers better interest rates than most developed nations. The interest rate was a measly 0.10% in the UK and 0.25% in the US as recently as early 2022, while India offered anywhere between 4 to 7% for the same time period. Now the interest rates have gone up across the globe. Even then, a 2-year fixed deposit in the UK and US is somewhere in the region of 4% and is taxable. However, most banks in India offer about 7% for the same time period, and if you have an NRI account, then you do not pay any taxes on interest. So naturally, you stand to make better gains. Here is a worked example of how much would a 2-year term deposit in the UK return when compared to India. If you were to invest £10,000 in the UK in a 2 years fixed term deposit at the current rate of 4%, it will yield you £800 minus taxes at the end of 2 years, versus if you were to invest 10 lakhs rupees, which is the £10,000 equivalent in India at a current rate of 7% for 2-year fixed term deposit, it would yield you rupees 1,40,000, which is equivalent of GBP 1400, and you pay no taxes if you have an NRI account. So straight up, you've gained £600 more by investing in India. You can open a fixed deposit account if you have an NRI account, NRO account, or FCNR account. I have covered these in depth in part 1 of this series. I'll leave a link in the description box below. Make sure to take a look. Now, you may not benefit as much from an FCNR fixed deposit account as the interest rates are not as attractive as NRI or NRO. However, it can still be a better choice when compared to foreign FDs, as the interest earned in FCNR account is not taxable. Now, between NRI and NRO, if you want to use your foreign funds, then I suggest you go for NRI fixed deposit, as it allows easy fund transfers, easy repatriation, and any interest earned is exempt from tax. However, if you want to open a fixed deposit using income from an Indian source, then you can only open NRO fixed deposit account where the interest is taxable. So the next option is to invest in mutual funds, including ETFs and index funds. But before that, what is a mutual fund and why should you invest in mutual funds? Now, there are many analogies to explain this, but let's try and keep it simple. Let's say you've decided to enter the world of investing. Now, you could go and buy individual securities like stocks, bonds, commodities, etc. But it's not all that simple. You need to be in the driver's seat, driving those complex decisions of opening the accounts, monitoring the markets, knowing when to enter and exit the market. And it can all get overwhelming, particularly if you are a beginner. And that is exactly where mutual funds come into play. Mutual funds make investing simpler. Here is a pictorial representation of how mutual funds operate. The mutual fund house, also known as the asset management company or AMC, collects the money from investors like you and I with similar investment objective, and then with the help of professionals called fund managers, the house invests the pooled money in various securities. Now, it could be primarily in debt, equity, or both, based on the objective of the fund. Essentially, they take all the investment decisions on your behalf. So how do you go about investing in mutual funds? First step is to have a regular NRI account or NRO account. Now, if you're looking to invest income from a foreign source, then choose NRI regular account. If not, choose NRO account. Second step is to choose a reliable intermediary. While you can invest in a mutual funds directly with the fund house, it is hassle-free if you choose one of the SEBI registered online intermediaries, as they provide easy account opening and better account management. Please note, if you are an NRI living in the US or Canada, you may face restrictions while investing in mutual funds in India due to FATCA compliance. And it's very important to note that it's economical to invest in direct funds rather than regular funds, as you pay an extra commission if you invest in regular funds. The commission is then paid by the mutual fund houses to the intermediaries. Let's take a look at the different types of mutual funds. SEBI, the Securities Exchange Board of India, has grouped mutual funds into 5 broad categories. First is equity funds. This scheme invests predominantly in stocks and stock-related instruments. The risk associated with these funds are medium to high due to market fluctuations, but you can expect high returns. Number 2, debt funds. This scheme invests the majority of the corpus in fixed income securities such as bonds and other debt instruments. The risk associated with these funds are relatively lower compared to equity funds, but returns are lower too. Number 3, hybrid funds. As the name suggests, these are balanced funds that invest in both equity and debt, and the risk is medium to high, so is the return. Number 4, solution-oriented funds. These funds are focused towards a long-term goal, whether it's planning your retirement or your child's education, etc. These schemes are further divided into equity, debt, or hybrid to suit your investment goal. And lastly, other funds such as index funds or ETFs. These funds track popular indices such as Nifty 50, Sensex 100, etc. These are less risky as they closely follow the index, but returns are modest. Under each of these 5 categories, you can then choose funds that suit your risk profile and your investment goal. When you redeem a mutual fund as an NRI, the tax is deducted at source and any proceeds are then credited to your linked NRI account. Fixed deposits or mutual funds, which is better? While mutual funds are riskier than fixed deposits in the sense that you could lose your entire capital, you also stand to earn better returns, obviously subject to market performance. It always boils down to risk to reward, amount of risk that you're willing to take to earn better returns. So here are some facts. The average return on mutual funds for a holding of minimum of 3 to 5 years is approximately 15 to 19% in normal conditions. While turbulent market can produce negative returns, on an average they say Indian mutual funds have returned 8 to 10% even in these conditions. When market outperforms, the potential is obviously high. Some of the funds have returned a whopping 50 to 70%. You can either invest in mutual funds as a lump sum or on a periodic basis, also known as systematic investment plan. If you're a seasoned investor, then lump sum can be a better choice, especially if the markets are showing positive sign. However, if you are a beginner or an amateur, particularly in a down market, then SIP is a better choice as it will help distribute the risk by keeping your average low. The key to investing in mutual funds is to stay invested for a minimum of 3 to 5 years or more to increase your chances of earning positive returns. Number 3 is investing in stocks and derivatives. I do not recommend investing in stocks if you are a beginner. However, if you feel like you have enough knowledge about the markets and you would like to venture into the world of trading, then it's good to know that NRIs can invest in stocks and derivatives. There are, however, some restrictions. NRIs can only trade on delivery basis in Indian equities. What it means is you must take the delivery of stocks that you buy into your trading account, which is currently T+2. So if you wish to sell your stocks, you can only do so after the settlement period of T+2. So any intraday trading or short selling is not open to NRIs at the moment. With regards to derivatives, NRIs are only permitted to trade in futures and options and not in currencies or commodities. So in order to trade in stocks and derivatives, as a prerequisite, you will either need an NRI PIS account if you wish to repatriate the funds back into your foreign account. If not, a regular NRO account will suffice. Trading is not allowed if you have a non-PIS NRI account, which is a regular NRI account. In both the cases, you will require a demat and a trading account, which can be opened either with your bank or an online broker. When you sell a stock or close a derivative position, the tax is deducted at source and any post-tax proceeds will be credited to your linked NRI account. Number 4, investing in bonds. NRIs can invest in bonds such as public sector units, non-convertible debentures, government securities, etc. You can either hold the bond until maturity or sell it on a stock exchange midway through. If you hold the bond until maturity, it offers nil credit risk. Technically, they're risk-free and also provide reasonably good returns. Maybe not as high as stocks or equities, but like I always say, it boils down to risk to reward. So if you wish to trade in bonds, as a prerequisite, you either need a regular NRI account, which is a non-PIS account, or an NRO account, depending on your repatriable requirements. In both cases, you will require a demat account, which can either be opened with your bank if they offer you that option, or it can be opened with any online broker. Any applicable tax is deducted at source on any income earned from bond trading, and post-tax proceeds are then credited to your linked NRI account. And there you have it. I really do hope you found it useful. Take care until next time and invest wisely.